Hey everyone, some of you are probably surprised to see me back so soon 1 week after releasing the previous video. This is going to be a review of WISE's latest earnings report that happened last week. I know a lot of people have already covered the stock, some better than others. Maybe you get some people reporting up 1%, down 2%, beat 5%. But hopefully with my perspective, you'll be able to see some more nuances or slightly different insights, considering we covered this stock 7 months ago on the channel. And if you haven't checked out the initial deep dive I've done on WISE, I would encourage you to do so because there's a lot of useful information in there that you could use moving forward. The link's going to be in the description below. So let's start by doing a quick recap on the biggest headlines. Well, there's one specific headline I want to cover. WISE is now planning to list in the US, and this will be a dual listing, meaning that they're still going to keep their UK listing as well, so you don't have to worry about that. The goal, they say, is to increase the liquidity and hopefully attract more retail investors. They didn't say that particularly, but they just said liquidity. But I assume that's what they really mean. And as such, they would hopefully re-rate to a higher multiple. Now, whether or not that's going to happen, I'm not really banking on that because, to be honest with you, I've been through this before. If you follow this channel, you know that I've covered Kaspi International before, and they followed the same playbook. They've listed in the UK and then listed in the US. Have they re-rated to a different multiple than their initial, market that they're targeting? Not really. They're still in Kazakhstan, and as such, they have the emerging market multiple. So whether or not this is a different story for WISE, granted they are not operating in Kazakhstan, remains to be seen, but I wouldn't be banking on this as part of my thesis moving forward. And to be honest, it never was. One of the reasons WISE was down after earnings was due to the ramp up in SG&A spending. And the market didn't like that. And the rosy narrative that WISE was purely a word-of-mouth business with very little customer acquisition cost was starting to lose its shine. And as you can see here in the chart, there has been a large increase in the SG&A spending, going from 296 all the way up to 465 over the course of 2 years. This has largely been driven by the recruitment side of the business, where they've increased their employee headcount by around 1,000 from an existing base of 6,000 employees. So you can see how much reinvestment WISE is planning. And this is also compounded by the one-off charge of £35 million as a result of their listing in the US. It's also possible that the market was hoping for some further news on the stablecoin development front, which I will cover in a later part of the video. Active customers have continued to grow up 18%, and cross-border volumes up 24%. And then you have the customer holdings are up a massive 37%. However, underlying income is up only 13% so far. And just to remind you, underlying income is equivalent to the revenue. As far as the guidance goes, WISE has reiterated their guidance of achieving 15 to 20% growth in their underlying income, and as well targeting the 13 to 16% PBT margin, which is their profit before tax margin, equivalent to their operating margin. I think it's also worth zooming into the key KPIs a little bit further though. On the quarterly year-on-year growth, we can see here that there's been a steady decline in the dark blue line for quarterly customer growth. And very similarly, there's a similar decline in the quarterly underlying income growth, both hovering now at around 15% or so. And card and other revenue has also seen a precipitous decline here in the pink. And this is tied to revenue associated mostly with the WISE assets, which they use for investing customers' funds into securities and giving them a return on their investment. However, the silver lining here is that the cross-border volume continues to be ticking upwards nicely and is growing at a 24% clip so far. This is an area of strength for WISE because they continue to invest in price, driving down their take rates and increasing volumes over time. And they're banking on the fact that the lowest cost provider ultimately wins. As for the customer holdings, I think this is actually one of the most important slides of the whole presentation they had on the earnings call. Customer holdings are actually accelerating from 31% to 37%, which I really like to see. If you ask yourself, would you rather grow the number of customers you have or the balances of your current customers, I think I would choose the latter. This is because that's something you can actually monetize right now. And you can see the effect this has had on their interest income over time. Despite a 25% reduction in interest rates going from around 4% down to 3%, the net effect of this reduction was actually just a negative 1%, which is quite an impressive stat to pull off considering how dependent they are on interest income as a business. And if you really want to understand how net interest income works its way into their bottom line, this slide explains it perfectly. If you recall, we had the interest income of 206, which is the dark green bars over here, and that's split because they retain only 20% of that and are supposed to hand over 80% of that back to customers. However, that's only in theory. What happens because WISE is not supposed to be a bank, it's not allowed to hand over those funds back to customers in certain regions and countries. As such, they retain a large portion of that 80% they're supposed to hand back, roughly half of it, and that ends up in their pocket. So you can see why it's actually sort of beneficial for WISE not to be labeled a bank, and they'd rather keep it that way if they can. Now let's reflect on the past 7 months and what's changed in WISE's business. At the time of the deep dive, WISE was boasting a 63% instant payment speed, which means that these transactions were completed in less than 20 seconds. And their take rate had gone down steadily all the way down to 0.59% or 59 basis points. Fast forward to today and we can see that their instant payment speed has increased up to 74%. And their take rate has dropped further to 52 basis points. So overall, to me, the story seems intact. Yes, there are some blemishes around the edges, but they are still growing at a 15 to 20% clip, which is a respectable growth rate given their size. And they haven't shifted their guidance at all during this past year. So hopefully we can hold them to that without any further surprises. Now, I want to quickly talk about WISE platform. And if you weren't already aware, WISE has 3 products. They have their main WISE account, their WISE business, and their WISE platform. Out of all these operating segments of the business, I have to say that the most interesting one for me has to be the WISE platform. Just to recap for anyone not familiar, this is their white label solution they're offering to banks in order to use their payment rails for their payment services and transactions. You have neobanks like Nubank and legacy banks like JP Morgan using this service. And there's a clear network effect that can be activated if WISE has managed to scale this side of the business. This would look something like an S-curve adoption, and we are clearly in the first innings of this, as only 5% of the revenue is being handled through the WISE platform. But they do anticipate that this would grow up to 50% of their total volume in the long term. And they've also recently announced partnerships with UniCredit Bank and Raiffeisen Bank, which I believe is an Austrian bank as well. So there is a long-term trajectory they're working towards. And you guys might slay me for saying this, but I'm going to make the comparison anyways between WISE platform and Google Search. The fact is, when Google first released its products, in order to get it into the hands of as many people as possible, it was designed to be a white label solution to be used by customers like AOL, who had the largest customer base at the time. Eventually, they managed to grow enough traction that people would come straight to Google Search. This wasn't their only avenue for using Google products. Similarly, WISE offers its own payment rails under the brand name WISE, and offers the white label solutions under WISE platform for the banks and financial institutions. So I really think if you're making a bet on WISE today, it's about the future of the WISE platform. All right, let's quickly review the direct connections because I think this is also a very important part of their business. And this is inherently what's driving down the cost and increasing the speed of the WISE services. And as you can see here, 46% of their transactions are handled through these direct connections with financial institutions and central banks. And I would have loved to have seen that they've increased the number of direct connections that they've had in this earnings report. However, they didn't report any new additions to those. They're currently sitting at 8, and they've been 8, I think, for the last year. And this is where I think stablecoins have a real advantage over the likes of WISE in terms of speed. Generally speaking, lawmakers and regulators have been playing catch up in the crypto space in comparison to the likes of WISE, which is operating in a very heavily regulated and compliant environment. But generally speaking, I'm sure they're going to keep increasing the number of direct connections they have, and they might have some news for us over the next 6 months. So speaking of stablecoins, on my second video that I covered WISE, and that was regarding how stablecoins could be a threat to WISE. If you haven't checked that one out as well, the link will be in the description. I did talk about how there will ultimately be a reckoning between WISE and stablecoins. They either have to adopt them or risk being left behind. And there are a ton of companies that are adopting stablecoins at this stage. MoneyGram, for example, which is a semi-competitor to WISE that works in the remittance space, has already stated that they're planning on ramping up stablecoins as part of their services. And you can see some of the legacy players that are involved. These are names like BlackRock and JP Morgan. Like, you would expect WISE to be ahead of the curve when it comes to the adoption of stablecoins, not behind it. So I'm unsure as to why WISE is being so cautious. Do they fear that they're going to be cannibalizing their own payment rails? But in reality, that was never going to be the case. There's always going to be a need or a service required to on-ramp and off-ramp these stablecoins back into fiat currencies. They should really be positioning themselves as the toll booths for on-ramping and off-ramping crypto for the entire fiat network. The good news, though, is that management's tone has definitely changed over the last couple of quarters, and it seems to be a lot more optimistic about the adoption of stablecoins. As some of you may be aware, WISE has applied for a US trust charter with the OCC, which means that it will be able to act as a sort of bank in the US. And this would endorse its position in the eyes of the financial institutions in the US and allow it to hold customer funds and even stablecoins. So I believe this is why they've been so tight-lipped about the stablecoin situation. Hopefully, once they do get this approval, we're going to see a ramp up in the number of services they're going to offer in the crypto and stablecoin space. All right, so now it's for the juicy part. We're going to talk about the valuation. So I think it's worth reflecting on my initial price targets when I made my first deep dive, which is a target price of roughly around £10 to £13.50. Or if you're looking it up on Google Finance, that would be 1,000 to 1,350. Now, I did spend more time on my initial coverage focusing on the deep dive and the competitive advantages of the business just to understand it to begin with. But in today's video, I probably spent more time doing the valuation part and try to understand the sub-drivers of revenue growth and really focusing in on the numbers more so than the actual business model and competitive advantages. So I built a pretty comprehensive DCF for this one, focusing in on all the sub-drivers for the revenue growth, and I'll be walking you through this right now. And for anyone who thinks this is too much, you can stop right here and you'll be totally fine. You don't need this kind of DCF analysis if you just really want to understand WISE, but if you would like to develop some guardrails in terms of what your expectations are for the price moving forward, I think it is useful to have some kind of valuation framework, whether it's a reverse DCF, or a regular DCF, or some other form of valuation method that you're comfortable with. I'll be providing a link for my spreadsheets on my Substack, which you can find also in the description below. And I would encourage you to subscribe to that so you don't miss any of the earnings updates and reviews. Hopefully that I'll be doing moving forward. Now, without further ado, the revenue drivers I've listed are going to be on your screen somewhere here. I don't want to go through these one by one, so I'll tell you what my assumptions are at the start for these revenue drivers and what the end assumptions are. And then you could play around with these if you'd like to figure out what is best for you. As far as trying to forecast 10 years out, it's going to be very difficult, but we're going to try to do this anyways. Now, it makes sense that the take rate will continue to decline over time. The cross-border volume, customer holdings, and card revenue, I expect that to slow down just above GDP growth or risk-free rate, maybe 4 or 5% towards the end. And the interest rates to be fairly stable between 3% to 2.5%. I don't think those assumptions are too crazy, and we end up with a total revenue of around 1.65 billion for the year 2025, which just passed, and ending up in 2035 with around 5.2 billion. Is that crazy? I don't think so. I mean, they more than double their revenue, which is very plausible. Compounded growth rate over 10 years of around 12%. Which I think also based on your knowledge of base rate growth by Michael Bobison, I think that's actually also somewhat achievable for the most, highest quality businesses. So how does that revenue growth then feed into their DCF? Well, factoring in everything that we have, first of all, DCF per se is not the right, it is a discounted cash flow, but we're using a free cash flow to equity. DCF because, of course, net income is more important than free cash flow in this sort of business. And I'm assuming that the operating margin will continue to drop down. This is equivalent to the PBT margin we spoke about earlier in the video, because that was the long-term target for the business, that's saying they're going to achieve 13 to 16%. Whether they go higher than that in 10 years' time, of course, they're not forecasting that, but I'm making the assumption that they stay within this target. And based on these assumptions, I end up with a rate of return of 12.6%, which may not be the highest, but it's also not the lowest. And when I do play around with the margins and the growth rates, I do end up with, on the lower end, to a 9% rate of return. And on the higher end, I don't think I can stretch past 14%, to be honest with you. So I think 12.6% is roughly in line, or actually the price target is around 1,350. That's in line with what I set out 7 months ago. It hasn't changed much. Could you get this business at a cheaper price? Possibly, but ultimately there's still a lot of room for further optionality in this business that's not being accounted for in the DCF. If they become the leading platform for on-ramping and off-ramping, that's the toll booth that we can't really factor in at this stage. So hopefully this earnings review has been useful to you. This is the first time I do release an earnings review. I had been hesitant to do so because I focus mostly on deep dives, but do tell me if you enjoyed this format so far. And if you want more WISE content, you can find the links in the video. The Substack will have the spreadsheet as well. And hopefully if this goes down well, I can also review the earnings of Kaspi and Crocs and Lululemon and other companies I've covered in my deep dives. But until then, please take care and I'll see you in the next video.